folks are watching what's going to happen with interest rates. We have already seen our Bank of Canada cut a couple of times. They're expected to cut again in September, as is the U.S. Federal Reserve. There are growing expectations that as we move into next month, that we are going to see the American Central Bank join our central bank in rate cutting mode. What does that mean for the stock market? Well, depends on where we go in terms of rate cuts and how the economy performs. Now, the team at CFRA Research has done some great work on those kind of scenarios. So let's bring in Sam Stovall, their longtime chief investment strategist, for what the numbers say. Sam, great to see you. Thanks for your time.
Hey, good to talk to you again, Jonathan.
It does feel like this rate cutting environment has, or at least a little bit more confidence in the U.S. that is coming in the not too distant future, has given investors a reason to muscle their way back into the stock market. What are you going to be watching? What are the kinds of scenarios in a rate cutting environment that dictate the kind of stock market performance we typically see?
Well, first off, I don't expect the Fed to be coming out like an Olympic sprinter exploding from the blocks with a 50 basis point cut. I think they'll do 25 in September, again in November and December, and then 4 more measured 25 basis point cuts in each of the 4 quarters of 2025. So I think the Fed wants to say that it is not behind the curve, but at the same time remains aware that they don't want to make the same mistakes as they did in the late 70s, early 80s. History basically says, in a sense, be careful what you wish for in terms of the start of a rate cutting cycle, because the markets tend to take a breather. Whether you look at large, mid, or small cap indices here in the U.S. going back to 1990, essentially what you find is that they're up only about 0.5% in the month after the first rate cut, with most of the action actually taking place below the surface, with the interest-sensitive and defensive groups doing the best and the more cyclical sectors treading water along with the market.
Okay, that's good to know, and maybe that'll be the theme that plays out this time. Who knows? I guess the other thing is that, correct me if I'm wrong, when there is a rate cutting cycle, if a central bank or if the Fed is cutting into an environment where the economy is still holding up relatively well versus a recessionary environment, that tends to be the kind of scenario that is better for stocks, correct?
Absolutely. I did a little study looking back to 1989, which is when the Fed started telling us that they were making Fed funds changes. Prior to that, they only announced discount rate changes that typically took effect after the Fed was sort of tweaking with the Fed funds rate. Anyway, what I found was that the S&P 500 was within 6.5%, new all-time high, when the Fed cut interest rates for the first time, and then went on and reached a new all-time high within an average of 48 calendar days. So the implication is that right now, with us being only about less than a percentage point away from a new all-time high in the S&P 500, if we reach that level before the Fed cuts rates, we probably still have more new highs to go after we have seen the first rate cut. But as I said earlier, probably the gains will be more muted.
Meanwhile, Stam, as you know, we have seen gold hanging around all-time highs. One of the catalysts for bullion's run this year seems to be the expectation around rate cuts. In Canadian stock market trading, gold stocks have had a huge year. The CFRA Research team has looked at a name like Newmont in the U.S. as a stock with some interesting characteristics, has had a nice run. But tell us a little bit more about the research CFRA is doing on a gold stock like Newmont.
Well, along with that, I did go back, as I said, to the early 90s, and all sizes, all styles, and every sector except financials posted average rate increases or price increases 30 days after the Fed started cutting rates. And the best performing sub-industry was gold, up 14.2% on average versus only a 0.4% rise for the S&P 500. Now that's gold mining stocks. So my thought was, well, then where do we have buy or strong buy recommendations? Royal Gold is one of them, but Newmont Corporation has a best buy ranking, and essentially obviously, it's a forecast for higher gold prices. Add to that the geopolitical tensions in the Middle East. Lower yields tend to be positive for gold because now you have less competition, also less cost to store the gold, and as a result will probably lead to better operating results for Newmont in 24 and 25.
You know, the other thing that seems pretty clear in this stock market right now is that the macro environment and monetary policy will be influences, but there are things that can help companies to navigate any economic environment, and that is brand loyalty. Before you joined us, we were just talking about the shoe business. Foot Locker's having a challenging day. It's amazing to me that you can look at the performance of a stock like Crocs this year, and the CFRA Research team has also been looking at that business, and a very impressive move. Don't seem to be, a company tied to Silicon Valley in any way, shape, or form, but a lot of momentum behind it as an investment. What have you guys seen in the fundamentals behind the business?
Well, we do have a 5-star or strong buy recommendation on Crocs. Footwear was the third best performing group on average in the 30 days after the first rate cut since the early 1990s. And our analysts think that the company is benefiting from brand loyalty, as you just mentioned, brand momentum, the growth in casual footwear, obviously as more people are working from home, or at least when they go out, they don't feel as if they have to get all dressed up. Certainly it is being adopted by younger generations. I went in looking for old stodgy kind of shoes the other day, and I was overwhelmed by the variety of Crocs, whether they were related to Star Wars, what related to Ninja Turtles, as well as just different colors. So I thought it was interesting how obviously the focus is on the younger generations, and they're probably going to want to have a multiple of shoes in their closet to use as accessories, if you will. So it's what we call a major trend in personalization we think will benefit Crocs.
Well, speak for yourself on the Croc styles, because the Ninja Turtle styles sound good to me, Sam, but maybe that's just me. Listen, I want to talk about one more stock, because today I noticed that AECOM in the U.S. is at an all-time, or a 52-week high. We've talked a lot about some of the bigger thematic trends around infrastructure building and investing. We got a company up here in Canada, WSP, which has been pretty popular with investors. AECOM, though, is a company that has a pretty good CFRA rating as well. How come?
Well, what I like to do is, I guess you could say I'm the kind of guy who likes to wear a belt and suspenders. So in a sense, I look to both technicals and fundamentals. Fundamentals tell you what, but technicals tell you when and how far. And AECOM is one that carries a buy recommendation by our fundamental analysts, and also has a very strong momentum ranking in our Lowry Research or technical analysis side. And mainly it's because of the performance of the construction, transportation environment, and the infrastructure spending that we think will continue to ramp up as we move into 2025. So here is a company that is benefiting from it, that is not one of the companies on the top of one's list of engineering and construction firms, but we think it has some very strong upside momentum.
Sam,